Now, to start with, we have a disclaimer. Now, why do we need a disclaimer in our asset class of digital assets? Well, for most of the industry, there is no disclaimer. It's the Wild West, it's unregulated. So that's an interesting thing for you to observe, is we actually have a disclaimer because the way we present this capability into market is via managed investment schemes. So we fit into the environment of regulation, and we'll share with you how that all hangs together today. So the normal disclaimer that you're very familiar with. So before we get started, this will kind of position why we're having this conversation. I mean, my background is intrinsic value investing. You heard that I worked at Tyndall, became known as Nico Asset Management. I had a very real struggle with this asset class, trying to get my head around what it is and also equally what it isn't. So I came into this space as the cynic and skeptic of the sector, from my perspective personally. I'm a great fan of Warren Buffett, and I was of Hamish Douglas as well. And both of them very much had a very strong opinion against crypto. So I'm not saying that they're wrong. I think they're right in terms of the way that they see investments through an intrinsic value lens or intrinsic investing. But that becomes important when we see how this works vis-a-vis that way of investing. So the first question is, how many of you have had inquiries from your clients in the last 12 months about crypto? You've done most. We did a survey with Financial Standard, 77% of advisors said that they'd had inquiries from clients in the last 12 months. How many of you feel able to adequately respond to that inquiry? Got one in the room. So the survey said 11% felt that they could adequately respond. So our business came into existence to solve that industry problem, and I will explain how that works. So there are two major things that are really important in this area of investing. The first is custody, safe custody. You'll hear today that Bitcoin itself is not a problem. The challenges are the ramps in and out of the sector. So who here's Googled any of this stuff? I think we probably all have at some point. It's okay, we're not talking about something else you might have been looking at. The reality is that you have to go past about the first 10 things before you get to content that's of any real value to you, and it's hard to know what you're looking at, isn't it? And imagine your clients, the stuff that they're consuming, whether it be through YouTube or Google. So part of our proposition was we need to help the industry, and we think actually the advice industry could be the white knight in this experience. As we know, who here has used an exchange, a digital exchange? A few. Are you aware that they're unregulated? That if they go down, you lose all your money. There's no consumer protection. For those that have been in that environment, you'll notice that there's gamification, it's a quite enthusiastic environment to operate in. They make money out of transactions, not out of quality, or is it a good investment idea? So the first part around education is finding good content that you can trust. So me being that cynic and skeptic, we came into this space and have created, that booklet is an example for you, CPD content, so it's free on our website, and you can utilise that to get yourself at least to a stage where you can ask the conversation of your clients, well, okay, are you playing in this space, what are you doing? And you've got a basic or a reasonable understanding by the time you've done that content. So that's there for your benefit. I had a very interesting conversation with an advisor the other day who was using it with their clients, that CPD content, so that if they want to invest in Bitcoin, for example, encouraging them to do the content and do the quizzes, so that when they do actually invest, there's a common understanding of what they're about. So you'll notice there the image is, I described that to handle this asset class, you need to wear asbestos gloves. It's not for everyone. It's highly volatile. The ramps in and out are fraught with risk. So we have to go in with our eyes wide open. So over the next little while, I'll share with you some of the things, the traps, the pitfalls, the opportunities, what to look for, what to avoid, and we'll leave together with a better understanding. So our business is, by design, is it bringing together people with traditional investment experience and digital asset experience. We're not a digital asset team that's trying to come into the investment space, importantly. And you'll see that when we get to some of the observations later on. So when we discovered this anomaly in the market that we wanted to help solve for, there are a few things. We had to design our philosophy. It goes beyond investment philosophy. It's what's our beliefs, what's our values, and what are we actually trying to do here. Our observation, and as I said, I come with that cynic and skeptic perspective, is the biggest risk to investors is custody. So you'll see that we have built a process that basically resolves that, so that if there's an application into a product, you'll know that from when the cash is received to it invested in Bitcoin, it's safe, the way that it's managed. Alpha is not yet proven in digital assets. So there are managers that are operating in the picks, spades and shovels space of the sector. You've seen an ETF launched that's called a crypto ETF that doesn't invest in crypto. But the interesting thing is, like all asset classes, is it takes time to prove up alpha. As you know, a new fund manager starts, you like to see a track record, and the asset consultants like to see a track record. That takes time. And in the initial phases, it's very hard to tell the difference between luck and skill. So while some of the numbers are dizzy, it's worth watching how that unfolds in all market conditions. There are many risks excluding Bitcoin. We're going to talk about Bitcoin and why it's different to the rest of the ecosystem quite specifically today, and that's not an accident. There is a difference. You'll find, there's 10,000 ways you can invest in crypto, call it 10,000 coins. Most of them go to zero. ASIC consulted the industry with CP343. It's not in your sort of central view, so you may not be aware of it. It happened in July last year, and then they came out with a response about, okay, they looked at the rest of the world. This emerging asset class is coming into the mainstream investment world. How do we manage its way in? How do we regulate it? How do we make sure that consumers have the right protections and so forth in place? So there are two major pieces of work we've done last year. One was about what we're talking about. The other is exchanges themselves. They're unregulated. So the Bragg report brought forward some recommendations, and they're being worked through for the exchange part of the market as well. So rug pulling, pump and dump, all of that is problematic in the sector. And ASIC in their findings said that there are only two currencies or coins, digital currencies, that meet the requirement of being suitable for a PDS or an ETF. And they are Bitcoin and Ethereum. And their criteria was they're deep liquid markets, that's institutionalised in terms of market makers, liquidity providers, there's a futures market, there's a deep spot market. So all of the characteristics required for an asset class to operate properly is there. So only those two. What it means for product issuers is they need a change to their licence to include digital assets in their licence. And we're going through that process. So when we launched, the only way you could access this asset class was through a wholesale managed investment scheme. And that's now emerging. So the other thing for you to be aware of is you will see PDS product come to market, which is more in your view. So be ready for that. As I mentioned, Bitcoin's proven in terms of the protocol itself has been going for 13 years. It's not going to break. It's an incredible piece of engineering mathematics. The protocol is actually beautiful. It's the way you would describe it, even if you don't believe in digital currency or digital assets. And it is deeply liquid, and it has scale. And we'll talk about that as well in a moment. Now, I mentioned at the outset that Warren Buffett's of the world and Hamish Douglas's and others, and a lot of us, look through the lens of intrinsic value investing or intrinsic investing. Everything is related to interest rates. If it doesn't generate cash, it's not an asset. Reasonable assumption. This is actually different, Bitcoin in particular. So as we'll see, that has some characteristics which become very helpful for us when we look forward into the way that markets have occurred. So it's not unreasonable to say that we've seen asset bubbles occur, haven't we, in the last 20, 30 years. It's everywhere. We've seen massive liquidity pumped into markets. Some of it was GFC related, and then more recently with COVID. So what's occurred is all currencies have debased together. And the only evidence of that occurring is asset prices. So it's something to be very aware of. And what we're going to see is, well, what happens next in terms of if you're just stuck in an intrinsic investing world, you are stuck with the problems that reside in that world, and you'll see some solutions there. And then, of course, the last part for us is education is absolutely key to its appropriate use. Asbestos gloves, got to be very careful, and we'll give you some strategies about how those conversations might take place towards the end. So our solution is a wholesale passive. We buy Bitcoin in spot, put it in what we call cold storage. It's like a bank vault or a vault. It's like gold, and it's stored offline. There's an air barrier around it so it can't be hacked. The keys are sharded into 3 parts and stored in different places in the United States. It's that serious how digital custody is managed, and we participate in that process using our US-based digital custodian. So we'll go back to the beginning of Bitcoin for a moment for those that are just getting aware of it. Satoshi Nakamoto synonymously wrote a paper 13 years ago. The first commercial transaction happened in 2010, which was 10,000 Bitcoins to buy 2 pizzas. And of course, I just did the maths on the weekend, and actually, guess what's occurred? It's now 2 Bitcoin by 10,000 pizzas. And then you think, well, how the hell did that happen? And it goes to that heading. It's the story of network effects. So at the start, there was only a handful of people, cypherpunks, that were interested in this area, and it was a hobby. And it's found its way into the ecosystem of monetary assets and the economy. And now there's a network which is quite extraordinary. There's 120 million people that are exposed to Bitcoin. 24% of Americans now have exposure either directly or indirectly to Bitcoin. There is approximately 20,000 nodes, so people that are basically participating in decisioning around Bitcoin. So it's been an extraordinary story about the network effect, and that kind of gives us an insight as to why it's done what it's done. So Bitcoin itself is trying to solve a few things. When it started, it was really as simple as if you and I wanted to transact, I'm at a market and I wanted to buy something for you, you and I would just hand over cash to each other. It's peer-to-peer. There's no bank, there's no sovereign, there's nothing between us except we can transact freely. So in the internet environment, these people wanted to have that same experience. So there's no intermediary, it's direct. There's no bank, there's no fiat current, it's just direct, we're transacting together. So that was the beginning of it. It's gone through quite an extraordinary journey in 13 years. As you know, it went into what they call the dark times, where criminal activities saw it was a great way to move massive amounts of money around the world, undetected, or they thought undetected. And then in about 2015, all governments realised that we need to do know your client to stop that behaviour, and that's been enforced. So, for example, if you're Russian in Australia today, you can't use an exchange. They won't take you on, and that's been in place for a number of years. So what Bitcoin does is 3 things. When you get into this, as I said, there's 10,000 currencies out there. The first is it's really about security, to making sure that it's safe, and it is extremely safe. And it sacrifices some other attributes to do that. They use a thing called proof of work. So it's a blockchain, so every 10 minutes for the accountants here, every 10 minutes we review the ledger, and another block is issued. It's got all the transactions and the whole history of Bitcoin in it. And every 10 minutes another block is added to it. And the miners are rewarded for doing the work to solve the algorithm, to get the right for the proof of work, to get the right to mine the coins, and they get paid in Bitcoin. So there's a transmission of reward for doing the work. So Bitcoin it's a known scarcity. There are 21 million coins that are going to be mined. We're at the 19 million mark. At 2040, we'll be at 99%. So if you go to Economics 101, quite often pricing is a result of supply and demand. Supply is known. And that's quite unique when it comes to a lot of assets that we participate in. The 3 things that it's trying to solve for, the first is security, the second is decentralisation. So again, it's related to security, that no one has control over the network. It's totally decentralised. It's like It's like democracy. Doesn't matter how wealthy you are, you get one vote, right? Doesn't matter how poor you are, you get one vote. So there's no inequity in terms of your capacity in the democracy to vote. And Bitcoin is run on the same way. Now you'll hear proof of stake as an alternative model, and that becomes centralised because then it's related to how much of the asset do you own gives you how much voice you have in the decisions that need to be made about the protocol. So Bitcoin by design is pure, it's the most decentralised blockchain, and it will remain that way because if you think of game theory, if you change the amount of the supply, like you want to add more coins, you dilute its value. If you make it less safe, you dilute its value. So the characteristics, the game theory will allow that protocol to run its course. And then scalability, we'll look at that in a moment. People talk about, well, what about the next bright thing that's coming out? Won't that be better than Bitcoin? Well, remember what I mentioned about the network effect? Imagine what has to occur before you can actually take over the core purpose of what this is built to do. So the way to think of Bitcoin is it's digital money. It's a purpose and it's the network. And the ledger can be used for other purposes as well, and we'll explore a little bit about that. So Bitcoin now, if you think of efficient market theory, if you purport to that, then capital walks and talks. Bitcoin is now the 10th largest asset. If you think about it in the terms of an individual company name or a commodity, it's the 10th largest asset now. Ironically, number 11 is Berkshire Hathaway. Remember what I mentioned about Warren really not happy about Bitcoin? Well, Bitcoin's bigger than Berkshire Hathaway. Within the space, it's evolving as well, but Bitcoin still dominates because of its purity of what it is. And the next one that's emerged is Ethereum, and it's solving a different problem. Ethereum is really a protocol that's designed to take on work. So the DeFi product, DeFi, NFTs, those kind of applications reside inside the Ethereum protocol. So in a way, Ethereum is a bit like a listed company. If you think we're in a metaverse and we don't have any assets that we think of today, and there's just this alternative universe call it Craig's universe, doesn't really matter what we call it, but Bitcoin is a bit like the bonds. Ethereum is like listed equity, and then everything else is venture capital. It's crazy stuff. So Ethereum has proven to be useful in terms of its applications across a range of things, and you've seen the popularity of some of the applications that are coming out of that Ethereum platform. Beyond that, as I mentioned, ASIC has made that determination that nothing else is ready. But we may see over time some of these other coins emerge, and then there's obviously a very long tail, and a lot of it is that pump and dump. It's terrible. The only motivation for the issuance of the coin is to make money out of investors. Now, I mentioned the Bitcoin network. It really has three important elements to it. The currency itself, it's emerging as a digital currency. It's an alternative to sovereign currencies and fiat currencies. And we'll see at the end that that's actually quite important right now. It gives people an alternative. And then the network is growing, and it's growing rapidly. Year on year, it's up 80%, and it continues to grow rapidly, way above other growth profiles. And that's where Metcalfe's law and other characteristics come into place. We've seen it before in other things. And that provides the opportunity, but also the protection, because it's so dominant. It's very difficult for anything else to do what it does. And then the third element is we're starting to see applications layered on top of it. Now, in plain sight, we have assets that are not intrinsically valued that we really value. And the classic one for me is land. It doesn't generate any income, but it has an application if you build on top of it. So we're seeing now the Lightning Network is a way of people transmitting. You can go and buy a coffee. 5 years ago, if you went to buy a coffee with Bitcoin, it's a bit like Uber. The miners might say, oh, this is peak time, it's $95 to transact, but the coffee was only $5. So it was a really inefficient network in that sense. Now with the Lightning Network, you can just, like with your phone, just transact really easily and move money around, or Bitcoin, Satoshis as they call it, 100 millionth of a Bitcoin around. And that's creating another layer in that, solidifying that network. Importantly, we're starting to see retailers are starting to look at, well, hang on a moment. There are a whole bunch of people out there that are quite interested in this asset class, and they own some and they want to transact in it. So you saw Tesla experiment with it, Square offers it. We're starting to see other platforms starting to offer it as a currency, as a way of transacting. It becomes a marketing tool as well. So that's evolving. Quite often people make comparisons about Bitcoin, gold and fiat currency. So I just thought on one slide I'd just quickly go through some of the things that we can see. Gold's obviously durable, it's been around for thousands of years. The Bitcoin protocol is actually very durable. The reason there isn't a tick against fiat currencies is because of the debasement that's continuing to occur. And we've seen obviously currencies disappear altogether as well. As you saw what happened with the Russian ruble, they had to put interest rates up from 10 to 20% overnight at the start of the recent conflict. Fiat and Bitcoin are highly divisible, gold is not. So that's where it has more of a store of value utility. It's not really, it doesn't have a currency utility. It's fungible, gold and Bitcoin. When we say that, we're talking about cross-border. So obviously if you're in one currency and a fiat currency and you need to go to another, you've got to do a cross-border transaction. With gold and Bitcoin, you don't. It's borderless. It's highly portable. Now, what's unique about Bitcoin is it's verifiable. It's immutable, the ledger. You can't change it. Every 10 minutes when it's published, that's it. So it's very highly reliable and secure. And you are starting to see criminal agencies, enforcement agencies, unpacking and looking at where the money's gone, and they can trace it through the protocol. So it's very verifiable, which also should send alarm bells if you think of CBDCs, central bank digital currencies. What does that actually mean in terms of who can see what? You know, there's a great convenience in cash, isn't there? Because you own it, it's yours, what you do with it's your business. But if you're operating in a digital currency environment, your transactions are visible. So think about places like China, them issuing that to 1.3 billion people, what that might do. Bitcoin is scarce and gold is actually, Bitcoin is the most scarce because the supply is finite and it's known. In actual fact, the scarcity nominally increases because one of the difficulties around the Bitcoin experience is if you lose the keys, you lose your wealth. It's gone. You can't ring up, say, hey, I've lost my password, have you got one for me? No, Bitcoin is pure. So about $120 billion has been lost forever for people that have lost the keys. And we'll talk about how you can own it, but that's one of the great learnings as well. Of course, gold has the longest track record of all. So if we're going to touch this stuff, how do we access it? The first is exchanges. The pros are the convenience factor. You can set up an account in 10 minutes, you know, have a go in there, it's fun. The problem is if it collapses, you lose the lot, and there's gamification, it's totally unregulated, it's the Wild West. There's a lot of stuff in there that you shouldn't be even touching, but it's there. Convenience, lack of security, and there's gamification. It's not necessarily healthy for your clients. Self-custody is where people go to once they move out of the exchange. They get quite into it and they want to have their own wallet. And the pros of it are that you are your own bank, which is great. You've got complete control of it. The problem is estate type issues. For example, if you walk out the front here and you've got some Bitcoin in your own wallet and you get hit by a bus, I'm not sure the last thing you're thinking is, oh my gosh, what am I going to do with my Bitcoin? But it is a real problem. You will lose it. So self-custody has some benefits if you really like playing in the tech, but at the end of the day, you don't have safety. And we'll talk about custody a bit more in a moment. The proxy is what we talked about at the start of the presentation. The positive is listed securities are listed securities. It's very easy to wrap that into a PDF structure and offer it to clients within your licensing arrangements. It's straightforward as well. The problem is you take on market beta. So obviously if you're investing in equity, it's got a correlation with the equity market, a strong correlation. And when you'll see when we get to the reasons to use Bitcoin, you really don't want that characteristic to be dominant in the decision. And then the final way to access it is where the market's evolving and it's maturing, which is useful for you, is managed investment schemes or ETFs. So you can get a near pure exposure if you buy one that invests. The challenge is you want to look for ones with spot pricing, not futures, as the underlying exposure. We all know with futures there's a degradation between spot pricing and futures pricing. So custody. A non-custodial wallet is just a hot wallet. They offer them on the exchange and other places. Convenience to transact, but you can be hacked. The next is a cold wallet, where you start to mature and you get your own keys, take it offline, separate yourself from, again, and then you have those challenges around what happens if something happens or you lose your keys. And then the final part is a custodial wallets, and that's fine, but it's relatively illiquid and hard to get to, and it doesn't necessarily, it's not easy to do and not cost efficient to do if you're an individual investor. So, as I mentioned, in October 29, they released the way forward, and this is where this becomes interesting for you. Last year, it wasn't a possibility. Now it's actually available. And there's a checklist here that I prepared for you, just so you can see the different considerations that need to be made on how you participate if you choose to. The caveat being, again, this isn't for everyone. Asbestos gloves must be worn. So the PDS is coming. So the first thing that needed to happen is issuers needed to have their retail licence amended. ASIC has not amended any licences yet. Their applications are in. So that's an important step. ASIC still hasn't done or released a variation of licence for any issuer, but they intend to. The ETFs are on the way as well, as you've seen in the press, but they're not here yet. There are some issues, technical issues around the market making and the liquidity inside and what the ASIC requires that the industry is working through, but they will occur. So product is the first piece that operates within your licence environment. That's in the wholesale space, it's already here, the managed investment scheme. The retail space, it's not far away within the next 30 to 60 days, I would suggest. Research ratings is obviously the next step that you want to see. There's only 2 Bitcoin funds in Australia rated, both by SQM, ourselves, and one other. So they're the first to go into the sector. Others are looking at it. No one else in the market yet has coverage of the asset class. So when you're talking to your licensee, or you are the licensee, and you're talking to your underwriter or your PI cover provider, there is a research available. SQM is the place that provides it. Then, of course, you need to consider it for an APL, and then within that environment, look at model portfolio weights. We don't see this necessarily, as I said, it's not for everyone. So what we have seen as a successful model is a specific model that allocates to that. So a high growth, for example, fund with a 5% allocation to Bitcoin. Who's here heard of Raise, that micro app? They offer a Sapphire option, which is a high growth fund with 5% in Bitcoin, very popular with millennials and those that want to have a go without going through all of the risks and concerns that we've talked about today. PI cover is also an issue that needs to be reviewed. Some of the policies that we've had shared with us are silent, so you're fine because you've got an MIS structure or a future ETF structure. It won't slow you down. Others have in the endorsements an exclusion. It's worth looking at the definition of that. It was originally written because they were worried about exchanges. That's not the problem in this structure. So, it's worth having that conversation, and we're happy to assist you with any of those if they do come up. When talking to underwriters, there's a few things, or if you're the licensee and you're carrying that risk with your advisors, there's a few things that you can do to manage the risk around this pragmatically. Like in most things, it's about how do you manage risks is the important thing that we take from it. The first is accreditation. So we've curated that CPD content, which is balanced and neutral and safe to learn from. Centralist, if you will, is a good way to get started. Asking your clients how much you're willing to lose. So we looked at the United States experience. It's quite common over there now for them to be included in conversations, and that's literally what they say to their clients. It's very asymmetric payoff, so you might lose 1%, for example, and you won't with Bitcoin, by the way. The protocol's not going to break, but we don't know what the price will be. But it's not like it will go to zero. It'll just have a price, whatever that is. But asking that question, how much you're willing to lose, and then that defines their risk tolerance for it. The SOA review done pre-implementation is quite an effective way as a licensee as well. Have your compliance team, if someone holds their hands up and says, I've got a client that wants it, put in the draft SOA or the recommendation before it's implemented. And then setting asset limits. In the United States, the experience is 1 to 5% is the tolerance for the market risk. And with regular reviews, and we'll talk about that. So, if you had no exposure, and historical performance is no guarantee of future performance, but there are things we can learn about the characteristics and behaviour. Bitcoin's been through some massive ups and downs. It's had a massive crash in 2018, right through this period. So it's worth seeing just how it behaves. How does it correlate with other assets? How does it actually work is the insight that we look for. So the bottom line there is zero exposure. The next line is a 1% exposure. The important thing here is we're rebalancing monthly. Okay, so how do you dampen volatility? You control it. You control it by having regular reweighting decisioning. And then the higher outcome there is if you had a 5% allocation. Now, it would be reasonable to assume that the risk would just blow up as you put the allocation up, wouldn't it? Would that be just a hypothetical? What was really interesting was the outcome, though. Because of that discipline around reweighting, the Sharpe ratio actually went up. It improved with exposure. The overall return obviously has gone up. The annualised volatility has gone up, but not markedly, and this is because you've got this discipline around rebalancing. The maximum drawdown you can see is constrained because of the monthly rebalancing discipline, and you can see what it's done to annual returns. So the key here is having the discipline about revisiting the exposure, doing it regularly. Now, ironically, if you do monthly, quarterly or annually, it doesn't really change too much, but it is important that you do it at a typical client cycle when you're reviewing the portfolio with your clients. So the risks in Bitcoin, and then I'm going to move to a Q&A piece because I asked you all for questions and I got some, and so I've summarised them into 3 key questions that I want to finish with today. So the key risks are custody. Alpha's not yet proven. Many risks outside Bitcoin. The protocol is proven and there's deep liquidity in that asset. Non-intrinsic value makes it detached from nominal valuations, and we'll explore that in just a moment. Education's key, and management of volatility is key. So if you follow that checklist, there is potentially a way to use it. As I mentioned, we're supporting you with CPD content, so in that I gave you a look at that document for you to take away. That's an example of some of our work. There's more of it available on the website. Now, the 3 questions that I got asked were, what about ESG? Who here said about Bitcoin's bad for the environment? Anyone? It's a headline that gets around, and fair enough. That's the headline. So what does it actually mean? So the interesting thing with Bitcoin is a few things. First of all, the way it works is the only time that you mine is when you can get cheap energy. Otherwise, you just don't participate. And the world's a globe, and so when it's light and dark on the other side of the planet. When it's cold in one part of the world, it's hot in the other part of the planet. So there's always somewhere on the Earth that there's excess energy that's not being required but sitting there, and it's being wasted. And the proof point is that Bitcoin miners pay base bottom prices for energy. It's off-takes. It's when no one else wants it. It's the 50% off, 80% off in the supermarket bin. Otherwise, it's going in the trash. So the important thing to understand is the way the Bitcoin mining works is it only produces and only participates when the energy is very cheap. That's one aspect to it. The next is, in ESG, is if you're doing a wind farm, for example, and you've got these massive turbines you're putting up, it's going to cost hundreds of millions of dollars, and then the grid says, sorry, we don't need your energy today. They turn all those fans into the wind and they just stop. So they're not producing anything, and therefore they're costing, because you've got a long tail cost of that massive infrastructure spend that needs to be amortised over the life of the asset. So Bitcoin miners are now being seen as a way to make ESG projects viable. Without them, they're not. And you'll see that if you're doing any private equity placements or looking into this space, you'll see that starting to appear more and more regularly. As it is today, 65% of Bitcoin mining is green anyway. So it's already transitioning. And the last part is we've seen, like, for example, in Texas, flutes, gas flutes that are at drilling sites, and methane is released into the atmosphere, and it's 56 times more damaging to the environment than CO2. So Bitcoin miners are now coupling into those methane flutes and actually capturing that energy and converting it into Bitcoin energy or digital energy, which is actually doing a great service to the environment. So while Bitcoin is the 70th most consumptive nation in the world, same energy consumption as Sri Lanka, once you look underneath that, it's actually a very, it doesn't waste energy, it harvests wasted energy, is what it actually does. So that's a bit on E. The social piece is quite topical as well. You've seen El Salvador decided to try and decouple from the United States. They don't have their own currency and offer an alternative. And in that sense, it's been very popular. More people now have access to Bitcoin, have a Bitcoin account through a Lightning Network or another mechanism than they have bank accounts in El Salvador. There is about 2 billion people that can't enter the banking system. We're in a white-collar first world nation that banking is part of our fabric, but there are other places in the world where it's not. So it does have a social purpose as well. And then governance is very clear because the protocol can't be broken, it's immutable. The actual protocol itself is very robust, it's totally decentralised. No one sovereign can control it, no government can control it, no central bad actor can take over the protocol. The next one was CBDC, central bank digital currency. So the way to think about this is Bitcoin is not related to interest rates in any way. It's free market, it's determined by supply-demand forces. In the fiat world, it's all related to interest rates and sovereigns. So the way to think about a CBDC is you've got paper money, and then we evolved to polymer money, and now they're issuing digital money. But it's all related to the same thing. Government debt, the bond market, interest rates, issuance of currency itself, printing money. So we don't see that CBDC is a threat to Bitcoin at all. That's just an extension of what they're doing. Inside that, there's those risks around, like we mentioned, that transparency and visibility aspect that you'll get with that may not be popular with end users. And then finally, just the driver of demand, because supply is known and demand is actually what helps us understand what its future might be, and therefore what price might be derived from that supply-demand function. So let me just share a few insights there. The first is Bitcoin itself is not interest rate sensitive. We're going to a rising interest rate environment. We all know that. It's not intrinsically valued. So it sits outside that universe of anything that's related to interest rates. It's possibly an inflation hedge, yet to be proven, a bit like gold, but it has those characteristics because it's not intrinsically valued. It's not sovereign. So we're seeing geopolitical risks emerging around the world. It's not issued by a government. It can't be controlled by a government. Importantly, it's not fiat currency. As I mentioned, it's geopolitically agnostic, so that if any of those other things emerge as risks, it's like if you're a macro allocator at the moment, it has characteristics that are useful when you're dealing with this macro environment that we're operating in. And again, the last piece is its scarcity. So when you relate all of those characteristics to it and then start to think about where it might go, a lot of those were not relevant or evident or pursued in the first 13 years of Bitcoin per se. Mainly the network effect. What we're seeing now is that when we're talking to institutional investors, they're going, well, we might need a long volatility solution. Could this form part of that solution? It's an open question, but it's certainly where it is going.